Welcome to the deep dive. Today, we're getting into something pretty significant, the really sharp increase we've seen in U.S. tariffs.
Yeah, it's been quite the jump.
It really has. Just to give everyone a sense of the scale, the average U.S. effective tariff rate went from, 2.4% in 2024,
Right, that low.
then up to 6.2% by March 2025, and then bam, after an announcement in early April, it shot up again to a striking 24%.
24%. I mean,
Yeah.
that's a level we haven't seen since 1909, according to the Yale Budget Lab data, way back.
Exactly, since 1909. So the big question is, what does this all mean, for how the U.S. trades with the rest of the world?
It's a huge shift, no question.
Yeah.
And it immediately makes you think about the impacts, right?
Yeah.
On businesses, on what things cost, the whole global economy picture.
Right, and to try and get some perspective on what might be coming down the line now, we thought it'd be useful to look back.
Look back at another time the U.S. had major trade policy changes.
Specifically the 1990s. And the big one then was NAFTA, the North American Free Trade Agreement.
NAFTA. Kicked in back in 1994.
Yeah, 94. And its main goal really was to remove most trade barriers, the taxes on imports, exports between the U.S., Canada, and Mexico.
It was very much a regional thing, focused on North America.
That's the key difference, isn't it? What we're seeing in 2025, these new tariffs, they're not just regional.
No, not at all. They're much broader, hitting a whole range of trading partners.
So our goal here in this deep dive is to see if looking at that NAFTA experience can give us any clues, about the potential economic ripples from these current, much wider tariffs.
We'll be looking at things like inflation, economic growth.
And how it might affect everyday life, ultimately. We'll try to keep the jargon down, promise.
Okay, so let's start with the 90s. NAFTA. What was the thinking behind it?
Well, the basic idea, as we said, was boosting trade, getting rid of the barriers between the U.S., Canada, and Mexico, lowering those tariffs, those import taxes.
And did it work? Did trade actually increase?
Oh, yeah. The numbers are pretty stark. U.S.-Mexico goods trade, for example. It was about $81 billion in 93, the year before NAFTA.
Okay.
By 2020, it was over $535 billion.
Wow, that's a massive jump.
Huge. And U.S.-Canada trade saw a big increase, too, from roughly $211 billion in 93 to $526 billion by 2020.
Even Mexico-Canada trade itself grew like tenfold between 93 and 2018. So clearly, removing those barriers got goods flowing much more freely.
Definitely. But it wasn't without controversy, was it? There was a lot of debate back then.
Oh, absolutely, especially around jobs. You had some people arguing, freer trade means more jobs overall,
Right.
creates
Right.
efficiency.
Then you had the critics worried about job losses, particularly in the U.S., factories closing, moving production, that kind of thing.
The famous giant sucking sound warning from Ross Perot about jobs heading south to Mexico.
Right. And looking back, what actually happened with jobs, it's still debated, isn't it?
It really is. We definitely saw a drop in U.S. manufacturing jobs during that period, from around 16.8 million in 1993 down to about 12.4 million by 2016. So yes, a noticeable decline happened during the NAFTA years.
And a lot of people connect that directly to NAFTA.
They do, but it's complicated. The Congressional Research Service looked into this, and back in 2017, they basically said NAFTA likely did not cause the huge job losses feared by the critics.
Ah, okay. So maybe not the main driver.
Possibly not the main driver for the overall decline. But, and this is important, they did acknowledge that some specific sectors felt real impacts. Industries like textiles, apparel, automotive, even agriculture. They faced more competition. Some jobs were definitely displaced there.
So a mixed bag, really. Not a simple story.
Exactly. Aggregate impact might be small, but specific industries and communities can feel it much more acutely. Trade deals often have those uneven effects.
Okay, that makes sense. What about the flip side? Did consumers benefit? Did things get cheaper?
That's another key part of the debate. If you look at the overall consumer price index, the CPI.
Our main measure of inflation.
Right. It went up about 78% between 1994 and 2020. So prices generally rose.
Okay.
But get this, the price of apparel, clothing, actually fell by 11.5% over that same period.
Interesting. So clothes got cheaper while other things got more expensive.
Exactly. And the argument is that lower import prices, thanks partly to agreements like NAFTA, might have helped keep costs down for certain goods. And that could disproportionately benefit, say, lower-income households who spend more of their budget on things like clothing.
So some potential consumer benefits, at least in certain areas. Were there any unintended consequences, things policymakers didn't expect?
Yeah, there were a few. One really notable one was Mexican immigration to the U.S.
How so?
Well, the thinking among some was that NAFTA, by boosting Mexico's economy, would actually reduce the incentive for people to immigrate north.
Makes sense logically.
But the opposite happened. The number of Mexican immigrants living in the U.S. more than doubled between 1990 and 2000.
Wow.
A big factor was likely the Mexican peso crisis in 1994-95. It hit their economy hard, wiped out savings, made U.S. opportunities look much better. Some also point to NAFTA's impact on Mexican agriculture, like lower tariffs on U.S. corn hurting small farmers there.
So, an economic agreement having pretty significant social effects, too.
Definitely shows how complex these things can be. The ripple effects aren't always predictable.
Okay, so putting it all together for NAFTA, what was the final verdict on its impact on overall U.S. economic growth? Big boosts, small boosts.
Well, according to a Congressional Budget Office analysis from 2003, the overall impact of NAFTA on U.S. GDP, the total size of the economy, was probably very small.
Very small, really, after all that trade increase.
Yep. They estimated likely no more than a few $billion, which sounds like a lot, but in the context of the whole U.S. economy, it's just a few hundredths of a percent.
Huh. So huge impact on trade flows between the countries, but maybe not a massive engine for the entire U.S. economy.
That seems to be the assessment, yeah. Influenced specific sectors, trade patterns changed, but the broad macroeconomic impact was limited.
Okay. That gives us a really good picture of the 90s trade situation under NAFTA. Now let's jump back to today, 2025. These new broad tariffs. How do they really differ from that NAFTA setup?
The biggest difference, as we touched on, is scope. NAFTA was regional, U.S., Canada, Mexico. These 2025 tariffs are, well, much more global, hitting a wide range of countries.
So Canada and Mexico have exemptions now, right? Under the USMCA, the successor to NAFTA.
Largely, yes, from these latest blanket tariffs announced in April. But it's worth remembering that earlier in 2025, they were hit with tariffs on some specific things: potash, energy, cars.
Ah, right. So it shifted.
It seems the primary focus of these newer, broader tariffs isn't North America right now.
So which parts of the world are feeling the brunt of these new ones?
The analysis suggests Southeast Asian countries are likely the most significantly impacted.
Why them specifically?
It really comes down to supply chains. So many U.S. businesses and consumers rely heavily on imports from that region. Components, finished goods.
Right. So instead of NAFTA's targeted regional approach, it's now a much wider net. What are the immediate economic effects people are forecasting from these policies?
The immediate projections are pretty concerning, honestly. They point towards significant upward pressure on inflation here in the U.S.
Higher prices.
Exactly. And also a negative shock to economic growth, a drag on the economy.
And why is that expected?
A key reason is just how tangled up global supply chains are now. It's much more complex than even in the 90s. We rely on imports for so much.
Like what? Give us some examples.
Oh, think about specialized computer chips,
Yeah.
often from Asia, right? For everything from phones to cars, the clothes we wear, many made in overseas textile factories, medical supplies, sometimes from Europe, furniture, maybe from Scandinavia, toys, household goods, often Asia again.
Yeah, it's everywhere when you start thinking about it.
It is. And you can't just flip a switch and find domestic alternatives overnight.
Right.
It takes time, investment. It's not easy or quick to substitute away from those imports, especially in the near term.
Okay, so that dependence makes us vulnerable to these price shocks. How high could inflation actually go because of these tariffs?
Well, some economic modeling, like from RBC, suggests that if these tariffs stick around for a while, U.S. core inflation could get close to 4%.
4%. That's quite a jump from where forecasts were before this, right?
Yeah, their pre-announcement forecast was more like 2.7% year over year. So 4% would be a noticeable acceleration.
And what does higher inflation do?
It squeezes people's purchasing power. If things cost more, you can buy less. That tends to slow down consumer spending, which is a huge driver of the U.S. economy. So slower growth.
And potentially affects markets, too.
Could do, yeah. Equity markets might react negatively. And just the uncertainty around trade policy itself isn't great for confidence, business confidence, consumer confidence. We're already seeing signs of that.
And this must put the Federal Reserve in a tough spot.
Oh, absolutely. A real bind. Because normally, if inflation is picking up like that, they think about raising interest rates to cool things down.
Right.
But if the tariffs are also hurting economic growth at the same time, raising rates could make the slowdown worse.
So they're caught between fighting inflation and supporting growth.
Exactly.
Yeah.
It's a very tricky balancing act. It makes their future policy decisions really data dependent. They'll be watching inflation and growth numbers like hawks. It's hard to see them cutting rates much if core inflation is heading towards 4%, even if growth weakens.
Okay, so we've got the past picture with NAFTA, the current one with these broad tariffs. Let's try and draw some more direct comparisons now. What about jobs?
Well, it's interesting. With NAFTA, the concern and the reality for some sectors was job losses due to import competition, particularly in manufacturing.
Right.
With the current tariffs, especially on things like steel and aluminum, the concern is a bit different. It's about potential job losses in industries that use those materials.
Ah, so downstream industries.
Exactly. If steel costs more because of tariffs, a U.S. company making, say, washing machines or cars using that steel might become less competitive. Their costs go up. That could lead to job cuts in those manufacturing sectors.
So tariffs aimed at protecting one industry might inadvertently harm another.
That's the risk. And the Tax Foundation points to an estimate suggesting the cost per job saved in the steel industry due to tariffs was incredibly high, something like $650,000 per job.
Wow. That raises questions about efficiency, doesn't it?
It certainly does. $650,000 is a lot.
Okay, what about the impact on people at different income levels? We talked about NAFTA potentially helping lower-income folks with cheaper apparel. What about these new tariffs?
Well, here's where it gets potentially regressive.
Mm-hmm.
Both trade liberalization back then and these protectionist tariffs now seem likely to hit lower-income individuals harder, just in different ways.
How so with the current tariffs?
The Yale Budget Lab did an analysis. They estimate these 2025 tariffs could cost the average household around $3,800 a year through higher prices and lower efficiency.
Okay, $3,800 average.
But for lower-income households, they estimate the loss at around $1,700. Now, that sounds smaller, but it's a much larger chunk of their overall budget.
Right, a bigger percentage hit.
Exactly. And they specifically project apparel prices could jump 17% because of these tariffs. Again, clothing is something lower-income families spend a larger share of their income on. So it echoes that distributional concern, just from the opposite policy direction.
So whether opening trade or restricting it, lower income groups seem potentially more vulnerable to the negative side effects.
It often seems to work out that way, unfortunately. The impacts aren't spread evenly.
Let's talk big picture economy again, GDP. We heard NAFTA's impact was considered pretty small overall. What about the projections for these current tariffs?
Here, the contrast is quite stark. The Yale Budget Lab, again, projects a much more significant negative hit. They're forecasting a 0.9 percentage point reduction in real GDP growth just in 2025.
Almost a full percentage point slower growth.
Yeah. And longer term, they see the U.S. economy being persistently about 0.6% smaller than it otherwise would be. That translates to roughly $160 billion lost each year.
That's not small. That's a substantial impact.
It is. And they also project a big hit to U.S. exports, potentially 18.1% lower in real terms. So the scale of the projected negative impact is just much larger than what was attributed to NAFTA.
Okay, and globally, NAFTA was regional. These new tariffs are broader. How are other countries expected to fare?
Well, the global ripple effects are definitely wider this time. Interestingly, that same Yale analysis suggests Canada, despite the recent exemptions, has actually taken the biggest hit so far from the overall 2025 tariffs implemented throughout the year.
Really, Canada?
Yeah, they project Canada's economy could be 2.1% smaller in the long run because of this, maybe due to those earlier tariffs or indirect effects. China's economy is also projected to shrink slightly, maybe by 0.2%.
It just shows how interconnected everything is, doesn't it? U.S. policy causing potentially bigger percentage impacts elsewhere.
Absolutely. And it's worth remembering history here, too. Like tariffs on steel back in the late 70s, early 80s. Research suggests they didn't just raise prices, they might have actually reduced innovation and encouraged industries to focus more on lobbying for protection rather than becoming more efficient. That rent-seeking behavior.
Right. Unintended consequences again. So given all these potential impacts, inflation, growth hits, job shifts, global ripples, what are the experts and businesses actually saying right now? What's the reaction?
We're definitely hearing concerns. Small businesses, according to CBS News, are worried about a potentially devastating impact from rising costs due to tariffs.
Understandable. What about other countries, especially China?
Well, the expectation is that China will likely have a stronger response than perhaps initially anticipated, especially with talk of tariff rates on their goods potentially going even higher.
How far?
The existing average rate on Chinese goods was already up to 54%, according to ING Think. And there's been White House indication, reported by Inside Trade, that tariffs on goods from China could jump towards 104%. 104%. Wow.
Yeah. So China might respond with its own stimulus measures, maybe more retaliation against U.S. goods.
Yeah.
They've already called the U.S. tariffs a clear breach of WTO rules.
And this is likely heading to court, isn't it?
Seems probable. There are already legal challenges being filed, raising the possibility this ends up at the Supreme Court eventually. Plus, there are efforts in Congress to try and force votes on this new tariff regime, so domestic debate too.
And one other point on China. Some analysts think these tariffs, combined with their own issues like overcapacity in some industries, could actually push them towards deflation, falling prices internally, which is another whole set of economic problems.
Goodness, it's certainly a complex web. Okay, let's try and pull the main threads together from our deep dive today. What are the key takeaways?
Okay. I think the main thing is the stark contrast, right? You had the 1990s with NAFTA regional, focused on liberalization, relatively modest overall economic impact, though debated effects on jobs and some prices.
Right.
Now, in 2025, you have broad global tariffs, much more protectionist. The immediate projections are for significant inflationary pressure, a noticeable hit to U.S. GDP growth, and wider global concerns, including potential retaliation.
So while NAFTA's long-term legacy is still kind of argued about.
Exactly, whereas the forecasts for these current tariffs point pretty clearly towards significant economic headwinds, at least in the near term.
Okay. So looking forward then, what are the big uncertainties or implications we should keep an eye on?
Well, a huge one is just how long will these tariffs last? Will they escalate further? That uncertainty itself is damaging.
And the retaliation risk.
That's key. If other countries retaliate significantly, it disrupts trade even more, raises costs further, potentially leading to a tit-for-tat trade war dynamic, which generally nobody wins.
It puts policymakers in a really tough position.
Definitely. Navigating these tensions, balancing domestic concerns with global economic realities, it's incredibly complex, and we have to remember there are legitimate arguments and different perspectives on both sides. The benefits and drawbacks of free trade versus protectionism, the path forward isn't obvious.
It really isn't. Okay, that gives us a lot to think about. So maybe a final thought for our listeners to chew on.
Go for it.
All right. So given what we've learned from past experiences like NAFTA and seeing the potential disruptions from these broad new tariffs, what are the best long-term strategies, to ensure economic prosperity and stability, both for the U.S. and for our global partners? Are there maybe different ways to approach trade, ways that could better balance our domestic needs with the fact that, like it or not, we live in a really interconnected global economy?
That's the multi-trillion-dollar question, isn't it? No easy answers there.
No easy answers, but definitely worth thinking about. Thanks for diving deep with us today.